Ladies and gentlemen, the market is breaking people's hearts at auctions at the moment. It's done a runner, but commercial property hasn't yet begun. We've got the expert Steve Palise here, who's purchased over 200 properties for clients. Stay tuned.
Good morning, everyone. Welcome to Morning Minutes, episode 412, Commercial Property Investing Explained Simply. Super excited about this conversation. We've got myself, Michael Bergio, Mark Novak, special guest, Steve Palise, and author of Commercial Property Investing Explained Simply. Obviously, I predominantly do commercial property. It's my bread and butter, but we cover a lot of topics on the show. But this one, I'm excited for this one, and I'm very happy to have Steve on to talk about everything and anything. And where, as Mark sort of said in the intro, residential market's going crazy. We're seeing under 1% yield, 2% yields consistently, which is great if you've got residential in your portfolio. You're getting the capital growth, you're getting the equity, but a lot of clients are cash poor and they're looking for other alternatives to have a positive cash flow. They think about commercial property and they have nowhere near to start. They don't know an agent. They can't Google anything, but what can they do? And Steve's written a book about it and he's on the ground every day. Good morning, Steve.
Thanks, Michael. Hey, Mark. Thanks for having me on.
No problem. So talk us through what you do. Mark mentioned in the intro, you've helped clients buy over 200 properties. Tell us a bit about your background and then we'll segue into the book and why you wrote it.
All right. So I was originally a structural engineer. I used to design medical machines. Then I started designing mine sites. But in the background of that, I was growing my own portfolio. So I bought some residential. And then I got a job as a buyer's agent because I found I was pretty much up till 1 a.m. every night researching property anyway. So I went, stuff it. I might as well, if I'm doing it for fun, I might as well do it for a job. Got into a job. The company I was working for was really successful. So I bought about 500, 600 residential properties. And then about 5 years ago, shifted into buying commercial. I was one of the people that just said, commercial is too complicated, too risky, I'm not going to buy it. But I had a few clients with huge residential portfolios that could take on the risk in quotation marks. And then so I started researching, doing some analysis, and then found out you actually can buy lower risk commercial properties in residential in some sectors. So started chipping away at those, got up to about 200 properties as of date. But then the main thing I had is every phone conversation I had with the client, they didn't understand anything about it, like absolutely nothing about commercial. They just knew the preconceptions of high vacancy rates, they don't have capital growth, all those kind of misconceptions. So I actually planned just to write like a 20-page ebook. So any new client coming on, I was going to send them the ebook and say, look, read this ebook. It's going to answer a lot of your questions about commercial. Then we can have a proper chat about like what to buy or strategy and things like that. 20 pages turned to 80 turned to 100. And then I went, there's probably a book here. So let's just finish up. I wrote a book and yeah, that got picked up by a publisher. So it's in all bookstores now and online. And no, it's going well. I've sold a couple of thousand copies.
That's amazing. Because I think a lot of people just throw that. What's that saying? A broad brush over commercial property. They just put it all in the one basket. But there are so many different markets, retail, office, industrial. And then within those markets, there's so many different plays that you can do where you're buying a tenanted property or do you buy a vacant property, different yields there. What are you seeing right now in the market? And what are you sort of forecasting for the next sort of 6 months? To 12.
Yeah, that's a really good point, Michael. Like people just say, I know someone who had a vacant commercial property for 5 years, but it depends what it was. Like I said, there could have been an office space, could have been retail, could have been industrial. Where did they buy? Like I don't say don't buy on the northern beaches for residential because mining towns are going down. Like you're not comparing apples and apples. And then a lot of the other time, people are using the large stats to make their decision. So they say like, don't buy retail, retail's down. But when they look at that stat, they're actually talking about CBD retail, like the big Westfields that no normal person's buying anyway. They're buying the little strip malls and that, where most of them are doing really well. Like my local coffee shops, during COVID, business doubled, like actually doubled. Wow. So what you find, in terms of what I'm buying for clients, I just try to get as good a return as possible with as low risk as possible, and she'll obviously try to get the good capital growth as well. So mainly I'm buying a lot of industrial. I really like industrial for its versatility, because if you lose a tenant, there's lots of versatility you can get from it. You can have a car mechanic, a wholesaler, distributor, fabricator, storage. So they've got a lot of uses. So I really like those. You can also get comfort in those numbers. So if you like buying a warehouse, you can look at every other warehouse in that complex or the adjoining complexes and find which ones went vacant and how long they went vacant for. So for a first-time investor, they're quite good because you can get some comfort in the numbers. You can look at square meter rates for sale, square meter rate leasing, and actually start comparing almost apples and apples. There is a bit more to it, obviously, with like if you've got a longer lease or a good tenant or a big fit out or something like that, the price will change slightly, but you'll have some form of comfort. The next one I'll probably buy is what I call essential retail. So that's the suburban retail, much like the one in Newport I bought off you last week. So just something where people have to go face to face. People are always going to go to their local coffee store, massage, barber shop, nail salon, or something like that. So those ones need face to face. And now with the working from home culture, there's actually more inclination to go to a local one as opposed to the CBD ones. So a lot of those businesses are actually thriving. But again, as I've spoken to you in the past about, retail is a bit of a tricky one because you need to look at foot traffic. Whereas a warehouse might not care about like visibility on the main street. Retail, you need people walking past. So you can't compare a retail one street back from the main street with the main street one. So just in saying that, there's actually a lot less sample size when you're doing your analysis to make a purchase, because there might only be 20 shops on that street. None of them are being vacant in 2 years. What is your vacancy rate? You have no idea if it goes vacant, if it's going to be 6 months, 12 months, 2 years, what the demand is. So that's where you talk to people on the ground like you. So you talk to leasing agents and property managers and sale agents and find what is the actual demand for these. And if they say they've got a waiting list, beauty, that's a really good indicator for growth. So there's that one.
I got a question.
Yep.
Steve, just so for anyone who's just tuned in, you've written a book on buying commercials real estate. You are a hired gun for helping people buy commercial real estate. What are some of your happy purchases lately where you've gone, oh my God, I wish I could buy all this stuff myself?
To be honest, anything I bought 3 or 4 years ago is just ridiculous yields now, because interest rates keep dropping and the cap rates and net yields are tightening. I was buying stuff like up in Brisbane, 7.5 to 9 cent, like in Brisbane CBD and on the outskirts of the middle ring. And like now their cap rate is 6%. So these people now have a 10% net yielding asset that's worth an extra 20, 30% capital growth as well. So they've just won the best of both worlds. And that's a huge misconception we should probably talk about with commercial properties. Everyone tells me commercial doesn't grow the same as residential. It's completely false. If you go over the last 30-year average, they all have between 5 and 6.5% net average growth per year. And it's just, it actually has to, because otherwise you end up with a huge disparity in prices. You'd have a $10 million house sitting next to a $500,000 warehouse. It always has to remain on par. They just happen in different cycles. So people will see the residential market will have a really strong 7 years and the commercial will not do much. But then when the residential market's not moving, they're not watching the commercial market actually perform and actually grow. So they're not doing so. People have very short-term memories. They look at the last 5, 6 years and that's kind of it.
And they also don't know how to look at commercial. Like exactly what you just said there in Brisbane is the growth, which a lot of people can't tell. 9% growth down to 6% is 30% growth. It's just measured very differently. And I think that the problem a lot of people have, you can rarely get a like-for-like comparison. Like if you're looking at a 2-bedroom apartment in DY, you can bring up 70 sales in the last 2 months. And you can sort of see that price trend. You can look back and see it from 10 years ago as well. But with commercial property, like Newport, when we were talking about it, there hadn't been a tenanted investment sale in like 4 years. So it's very hard to bring that. So a lot of people just go with the conclusion of there's no growth, but you've got to know how to look at it as well. But I even think about now, like we just did a sale in Brookvale Industrial to a 600 square meter block for $2 million. And then we just did a DY knockdown house, 600 square meter block for $2 million. And I look back 10 years ago, they were both low millions. So, or even less. So it's just, but there had only that in the last 6 to 9 months, there'd only been one sale like I had done. So there is the growth there. You've got to dive into the numbers. And what does your book help? Like, take us through someone who may have 3 or 4 residential properties, is very successful. We spoke about this off air. There is nowhere to go to educate yourself, which leads people to look at those JLL stats on the CBD, on Westfields, that says retail is down the tubes. And then they go, well, that means DY retail, Newport retail is no good. That's because they don't know what to look for and they don't have the tools themselves to look for stuff. So how will your book help?
Well, that's exactly why I wrote the book, though, because there literally is no information. Like, you've got nothing. So my book just breaks down really simple, hence the title, Explain Simply. It just goes through each part of commercial. So it goes through like the types of assets and then how to calculate the numbers in terms of yields, cash flows, returns, and things like that. There is. And then a lot of the book is actually talking about the risks. So not what to do. So don't get carried away just trying to chase a yield, because a yield is great while you've got a tenant. It's not so great when you don't have a tenant. So that's what I mentioned before about getting the highest return with as low risk as possible. And then it'll just go through getting your team incorporated, what agents to deal with and how to deal with agents, how to survive a downturn. There's actually a chapter on that. So it talks about like losing tenants if there's a natural disaster, pandemics, things like that. So it's basically enough tools that you're mitigating the risk when you buy a commercial property. And as I mentioned at the start of this podcast, you can actually buy very, very low risk assets. Like I bought one up on Burleigh Heads for a client. It was a medical center on a 10-year lease that had a personal guarantee on it. So they've had a $300,000, $400,000 fit out. So on that a 7% yield, that actually pays itself off in 9 years. So on a 70% loan at a 5% interest rate. So it's going to be debt free before the tenant can even leave. So where is the risk in that one compared to buying a $2 million apartment in DY, rent for $650 a week?
Yeah. And for anyone watching this, we're going to have a giveaway of 5 books. If you like, share, comment this video. We will be doing a draw later in the week. So yeah, like, share, comment, all 3 of them to go in the draw. To do that, you can do the comment after it's live if you're getting ready for work and you're not ready. But let's give some simple tools for someone. What is sort of the top questions they should say to themselves and information they should look at when they've jumped from resi to commercial? So they've seen a property online. What's some things they can do at home after they've sort of read the book? Like, they want to look a copy of the lease, look at what can they sort of some data research they can do from home. What are the key things?
The 2 biggest things you need to look up when you're buying a commercial is, 1, check that the lease and the rate that they're paying, so the rent they're paying is fair market rent or below market rent, because commercial properties valued off the return that they give, the cap rate or the net yield. So you want to make sure they're paying, because there's no point buying something that's 10% over rented, and then when you get to lease renewal, they bring it back 10%, because you're going to lose 10% of your value there. So make sure the comparables, and that's not so simple as well. It's not like you go on realestate.com and you can have a look, because what they advertise on Real Commercial, for instance, is just what the going rate is. So a lot of the times you actually have to go on like Core Logic or something like that and look at the old sales campaigns, talk to people like you and find out people on the ground what the actual rates are doing. And you actually have to be knowledgeable of that, because like the square meter rate for, say, a warehouse in Brookvale is going to change if it's a 50 square meter warehouse or if it's a 2,000 square meter warehouse. So you need to find comparables for that rent as well. And then, much like residential, you want to compare the sales rates as well. So not just the rent to make sure you're getting good rent, actually the sales price. And as you said before, with that Newport one we bought, it's very, very difficult in some cases, especially if it's a tightly held market, which is actually a good indicator that you're buying in a good area. But it just means it's not like residential where you've got hundreds. You might have 3 or 4 or maybe 5. And not just that, the market's moving anyway. So comparing like a warehouse or a little retail from 2 years ago actually means nothing now anyway, because the market's moved 10, 20%. So it is more difficult. It's a little bit. Yep.
Yeah, Mark.
Just a quick question. Why did you buy Newport? Like, what were the markers and what were the things great for your client that you said, okay, that's a good buy? Because I think there's a lot of investors that have 500,000. At 500,000, they're buying a. You can't even get a one better in the Northern Beaches now. Why Newport?
So I like Newport because COVID now with the working from home, you guys have seen the spike with people like inquiring about moving to lifestyle regions. So something like a nail salon in a region where people are going to be there 3 or 4 days a week. They might still commute to the city 2 or 3 days. But they're going to be local. So they're actually going to go. So I call it essential retail. They're the ones I really like. So like a nail salon, people are always going to go there. They need someone physically to actually touch their hands. And that one's a crack. I really like it. It was a 6.2% net yield. So compare that with, say, a 3% gross yield for residential. So the gross yield is probably about, 10%, Michael? So
Yes.
So you've got that. It's on the corner, on the main street with double side frontage. And it's a versatile asset. If that tenant decides to leave in 5-10 years' time, for instance, it can be a hairdresser, can be a barbershop, can be a little cafe. It's got some uses for it because it's got the main thoroughfare of traffic. But I'm buying heaps of retail in those lifestyle regions. So anywhere where people are actually starting to move to, I think they're going to perform really well in the next 5 years.
And I love hearing that.
500 grand.
Sorry,
what's that rent per week or per month for someone that's got that coming in?
Yeah. It was 735,000 purchase with 45,000 a year net income. The tenant paid strata, the tenant paid council, the tenant paid water. So of 45,000, you get $3,750 a month. So of a week,
it's almost double residential. That's almost double what you're getting in residential at the moment. So
but you're also not paying rates and outgoings. So it's double the rent. And you're not paying the outgoings, which normally equate to about 2% or so.
Is the interest rate higher?
They are a little bit higher. They're generally 0.5% to 1% higher, but that's actually tightening now. So I'm seeing about 2.5, 2.8% on average for most clients.
Yeah, it's insane.
Is the deposit?
Go on, Mark.
Sorry, mate.
ANZ
is the deposit greater?
Yeah. So generally you need a 30%, sometimes 35%. However, there are a couple of lenders. I think Michael was going to say like ANZ are doing 80% loans at the moment. So it's actually like for like in those situations.
Yeah, so ANZ, I met with them a couple of days ago. They're doing as low as 2.5% on a 30-year term. 30 years with flexible deposits. So it's becoming so competitive. Like, Steve, you would have seen it a few years ago. People are borrowing money at 5-6%. Buying yielding assets at 5-6%. Now people are borrowing money at 2.5%. And keep in mind, especially at that entry point, a lot of the time the client's putting in probably 80% cash, 70%. And they're looking at it going, well, the money's in the bank, probably like doing nothing. Yes, I could buy residential, but I'm going to get 1 or 2. I'm going to get 2% net. I want money now. Or do I play shares or stock? But I don't really know that at all. My motto has always been brick and mortar. So commercial property is really key to look at that. And I think it's going to do well. What's your take on...
One point there, Michael, is so a lot of people, they might actually have that equity sitting there, but they actually don't have any serviceability to buy another residential. The banks have actually said no to them. But commercial loans, you can actually get lease loans where they give it based on the actual rent that you're receiving. So a lot of my commercials are on lease loans. So where you're capped out at residential, you actually can keep moving forward with commercial, and you sort of get the best of both worlds. You're increasing your serviceability at the same time because you've actually got a really positively geared asset.
Great point there, because that was the key thing they changed in residential lending probably about 3 years ago, where they started really calculating it on, we don't care if your properties are rented. We want to know you can pay for the rent of all those assets if there's no tenant there. And you're like, well, no, but it's a one bed. Of course it's going to rent. But to hear that, I wasn't even aware of that with the commercial. That's like, I sort of knew of it, but I didn't know the terminology. Or was it a lease loan?
lease loan. And then there's an even further one. You can get a no-doc loan where they'll give you the loan, basically no criteria, as long as you've got a 50% deposit. So a lot of like my trading clients who might be doing something a little bit dodgy with their tax, they've got a lot of cash, but they're not kind of got a lot of income. That's an option for them to keep buying as well. Whereas residential, they wouldn't be able to touch.
Yeah. And I think it's key that with a lot of the market sentiment at the moment, everyone's saying stay away. Like the sentiment is retail's down the tubes, don't look at it. But hearing it from someone who's helped clients buy over 200 commercial property, 600 residential, and just immerse yourself in knowledge about it, they're the assets you're looking for at the moment. So it just really hammers the point. Do your own research and don't just follow the sentiment or trends you're hearing, especially when it comes to commercial.
One of the big things with retail is people hear the word retail and they just naturally think of like clothing stores. And I used to be the same. Someone says retail and go like, oh yeah, a clothes shop. But a retail can be a medical center or a dentist. So that if they've got 200, 300 grand fit outs, if you've locked them into a long lease, they're not going anywhere. Like they physically can't leave.
Yep. Mark, anything? We're already at 21 minutes. I feel like I could talk longer. But
I think it's fantastic. And the thing I loved most out of today was people that are conking out on income to purchase an investment on residential, but do have healthy deposits, have got the option of commercial. I think that's a big thing. And I also think the residential markets had a bit of a run already and commercial has not, all in all. So, yeah, awesome, Steve. Thank you.
And just before we wrap up, Steve, for a client out there thinking about engaging your services, what do they need to best be able to contact you in their mind? They go, all right, I got a 20, 30% deposit. Of like what type of clients are best to contact you to help them with buyers, to help them buy a commercial property?
Anyone who's either time poor or doesn't know anything about commercial property, obviously reach out. But in terms of the starting point, you can buy a commercial asset 300 grand. Like you can buy little warehouses up in Brisbane CBD for 300 grand. So you actually only need about 100, 120 grand worth of equity or cash, and you get started. And that 300 grand one, you're still talking about 12 grand a year passive income. Like it's not a bad return for such a little bit of money.
Yeah, good point. And I think anyone who bought a property longer than 3 years ago will have that equity. Get in contact with Steve, see how he can help. I think knowledge is key, and then to be able to pinpoint a property that basically encompasses all that knowledge into practice, because there's no point reading all the books, doing everything, and then not being able to look at a real life example of what you can execute and buy and create your portfolio that way. So we'll have your contact details in the chat as well, and obviously a link to buy the book as well, but we will be giving away 5 books.
Awesome. Thanks for the time, guys.
Thank you very much,
Thanks,
Steve.
buddy.
Pleasure.
Unbelievable. Thank you. Awesome.
Cheers, mate.
See ya.